Good afternoon. Today is Monday, the 17th of November, 2008. This is Brian Shannon from alphatrends.net. Let's go ahead and take a look at this mess of a market that we have here. The NASDAQ finished lower here today by 2.1%. So we continue to obviously be in a bear market. These little one-day rallies and sometimes 2 or 3-day rallies are always going to be suspect until we have this 50-day moving average begin to flatten out and then start to turn higher. Same is actually true for the 200-day moving average when we look at the weekly time frame. So from an investing standpoint, it's going to take quite a bit of time before you can really consider investing long in this market again. Looking at the daily time frame, though, today we saw a new closing low for this market. So this is a new closing low. That can't be very inspirational to anyone who's still left with any shred of bullishness for whatever reason. Again, I think that most people who are bullish or looking to be bullish are trading more on hope than they are on actual, anything. Probably not fundamental, but certainly not technical. We've got a declining 10, 20, 50, 200, 100, 5-day, 2-day, 1-day. All the moving averages are heading lower. The 5-day moving average here on the 10-minute time frame, obviously, the market stayed below that all day. We had a little bit of a gap lower. Market tried to recover a little bit, and then here at the end of the day, the sellers came back in once again. Let's take a look at the 1-minute time frame. Most of the session it was above or battling with this daily VWAP. The 2-day VWAP never came even up to touch it. So the sellers clearly remain in control of this market. There's really not much reason to think that it's going to turn around or that it can turn around in here. We have to just look objectively at price action. If it can clear, this 29.5 level and maybe that 5-day moving average flattens out, then perhaps we start to turn a little bit. But still, we're in a primary downtrend. Any long side trade should be considered just a short-term trade, and that's it. And I had an email from someone who was telling me the definition of head and shoulders, and I apologize if I've misled anyone, but in order to truly be considered a valid price, something that you can act upon, it has to clear the neckline. The NASDAQ never cleared this neckline, nor did any of these other markets. So when prices are rejected from the neckline, it invalidates any reason for potentially looking at a price pattern. The reversal patterns, like a head and shoulders, come at the end of a bear market, obviously. But again, I'm going to point to the fact that we've seen literally hundreds of these inverted head and shoulders patterns over the course of this year. If you look at all these different time frames, some of them have made for good trades, most of them had failed, and most of the time they are going to fail because the primary trend remains lower. All rallies should be considered guilty till proven innocent, and price pattern recognition is such a very small, and I would even say unimportant piece of technical analysis in terms of the traditional, cups and handles, head and shoulders, and that sort of thing. It's not that they're necessarily unimportant. You want to look at them like anything, but you want to look at it and say, what's the potential here? Do I buy just because I see this pattern setting up? No, you buy because price breaks higher, and then it starts creating a series of higher highs and higher lows, and you listen to the messages of the market as far as how long to stay involved. You don't just take these measured moves and say, well, if it breaks there, it should go to this level, 34, so I'm going to buy at 30 and a half and then put my sell order in at $34 a share. That's foolish to do. You have to listen to the message of the market and continually adjust your plan. Your plan has to be dynamic because the market is dynamic. We get new information every day, every moment through price discovery, through fundamental data that hits the market, and so many other factors that influence people's behavior as far as buying and selling, that creates the trends that we try to take advantage of for these trades. So didn't mean to go on and on about that, but we still have a declining 5-day moving average. We have these prior lows in here that this market seems to be testing, but not any reason to be bullish in here still. The market remains in a downtrend, guilty till proven innocent, and it would not surprise me at all to see new lows, and perhaps we just continue the next leg lower. There's nothing in here that says we have to find support in here. This has been a pretty wide range that we've been in, 28 up to about 33, 34. So perhaps we're just going to trade within this range. If that's the case, as the trends reveal themselves on the shorter term time frames, those are the trends you want to take advantage of. But remember always that every rally in a downtrend should be considered guilty till proven innocent, which means you have to trade smaller share size, you have to be very quick with your stops, you have to have pretty tight stops as well. So it's a risky environment, long and short, because when you're short and then you get stuck in these rallies, they're super painful. So again, to repeat myself, I still believe, as I have been saying for most of the year, that we're in a day trading environment. Let's take a look at gold. It was down 65 cents today. 5-day moving average flattening out a little bit. Let's take a look at the daily time frame. It's still clearly broken. We've got a declining 50-day moving average, so nothing's changed in there. Same with oil. Oil down to a new closing low as well, down at 45 on the USO. And we were looking at this maybe a month or so ago, saying maybe we're going to get some support in here because it was a prior important level of resistance. When you look at a market coming down to a prior level of resistance, it only becomes potential support. There is no support until sellers stop selling and the buyers come back into the market and take control. Markets correct through price and they correct through time, and these markets all are going to need a lot of time to continue to heal. The Russell 2000 was down 0.85%. This market didn't hit a new closing low, but no reason still to be bullish in here either. We've got the lower highs and possibly heading towards lower lows in here. Let's take a look at the 10-minute time frame. We've got the declining 5-day moving average. We've got these lower highs in here. We've got lower lows. If we break this morning's lows near 44.90 or so, then it's likely that we're going to go down and test this level. Maybe if we break above this level here, this is the lower probability outcome, then the 5-day moving average flattens out and then it starts to begin to rally. You always want to be aware of all potential outcomes, but realize that when in doubt, give the benefit of the doubt to the larger time frame. And no matter what larger time frame you look at, it's clearly bearish for all these markets. So all rallies in all these markets are guilty till proven innocent. Let's take a look at the financials. Financials, new closing low in there as well. Nothing to be bullish about, obviously, in the financials. The only thing bullish you could say is they only have another $11.92 to go till they're zero, and it's dropped 30 points or 25, whatever. Obviously, I'm being facetious here. There's nothing bullish in this market. It continues to be in a downtrend. New closing low, not an intraday low, but it's hard to imagine that we're not going to go through those levels. And once again, the only people right now at this point who have bought the financials and are in a winning position, you had two 10-minute periods right here last Thursday where some people might be holding there. Other people are looking at these lows saying, I'm going to put my stop below that. And that's where we get those emotional give-ups below those when we see the market take out those levels. But big volume right here at the end of the day. Last few minutes we saw, similar to Friday, not as bad obviously, but we saw final, selling in the final few minutes. This market just has too much supply out there. There's still sellers, so you can look at all kinds of valuations and try to justify your purchases all the way down, but that's just going to cost you a lot of money, and you're going to end up losing sleep as well. The S&P 500 isn't making closing lows. We've still got a little bit of room here, maybe another point and a half, but Again, nothing bullish in here either. We see the volumes drying up, but that doesn't mean anything really. Again, only price pays, and when it's down 1.3% like it was today, it doesn't matter if it's down on light volume or heavy volume. You don't want to be an owner. This market, we were looking at the potential for a head and shoulders pattern in all these markets, because that's what the market's giving us. But until it breaks past the resistance, then this is just a little messy little pattern in the market. But when they break down, then you can't look at them seriously anymore. We've got lower highs in here. We've got these lows in here from this morning that were reached. Let's take a look at the 1 minute time frame actually. We saw the market hit these lows in here, recapture the daily VWAP, and the S&P had a nice little rally in here. It came right back down to VWAP. Very choppy in here for most of the afternoon, but once again at the end of the day we saw the sellers took control, pushed it decisively through that VWAP. The VWAP acted as resistance here, and then we had that final bout of selling. So these markets remain very fragile, very weak, and very risky, so just continue to be very careful.